Righto, we have just gone 1 o'clock, so we will kick off.
Okay, hi everyone. My name is Victoria. I'm the Group Marketing Coordinator at Sidekick, and I'll be moderating today. So just for those of you who might be unfamiliar with the webinar environment, we're just going to go over the team settings. So we'll just have a look at the webinar controls. If you select More and then under Audio Settings, you'll be able to select and also test your speakers. If you want to submit questions throughout the webinar, then click the Q&A button. We'll try and answer your questions as we go, but any that are missed we'll go over at the end. And if you need to leave at any time, click Leave Meeting. And also throughout the webinar, we will be having some polls. So if you're on desktop, it should just pop up. But if you're on mobile, you'll see a thing pop up saying names not recorded, results shared. You can just click into that to see the poll. Now I'll introduce today's presenters. So we've got Julie, Chartered Accountant and Group Operations Manager for the Sidekick Group. Julie has over 10 years experience in public practice and corporate accounting. And we've got Rick. Rick Thorpe is a co-owner of a number of firms within Sidekick. He helps lead the Christchurch team and supports the group's expansion across the South Island. Rick has been pivotal in cultivating a strong team culture and promoting modern accountancy. Now I'll pass you on to Julie, who's going to talk about why we're running this webinar and step you through the 6 key reports that you'll see in business.
Thanks, Vic. So just checking you guys can hear me okay? Awesome. And thanks everyone for taking the time to listen to this webinar. So I'm going to run you through why we're running this webinar. So Sidekick's core purpose is to help our clients be more successful. Success can look different for many people and at different stages of their life. For one person, it might be growing their business, and for another person, it might be working less and spending more time with family. So whatever success is to you, you need to understand your financials, as this helps you to understand the health of your business. So one key part of our brand promise is to give clarity and build confidence. And so not every one of our clients is in a position to undertake one-on-one coaching and training. And that's why we decided to run this webinar to give our clients the opportunity to learn more about their financials. And hopefully we can make things a bit clearer and make you more confident when it comes to your numbers. So before I start, I thought I would share a thought for the session. So the budget is not just a collection of numbers, but an expression of our values and aspirations. So your budget expresses your aspirations for your business over the next 12 months. Now it's time to make sure that you can understand, monitor, and measure what you've set in those budgets and forecasts. So this webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, or annual basis so that you're in control of your business's performance. So over the next 45 minutes, we'll cover the importance of knowing your numbers, an overview of the different reports that you should be producing, the difference between profit and cash, that's a pretty common one that we get asked, and the key drivers of business value, how to protect your assets, and how to adopt best practice. We'll then outline some potential next steps for you to take to make sure that you truly understand your numbers. So please make sure that you take plenty of notes today. Some of what we might talk about might sound like a foreign language to you, what I like to call accountanese. So send through your questions on that Q&A at any time during the webinar. And if we don't answer them throughout the presentation, we will have time for that Q&A at the end. Cool. So knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan or just the goals that you have for your business. So here are my top 6 reasons why you need to know your numbers. So they tell the story of your business, allowing you to interpret the results of your business activity. They can help you to find the symptoms versus the root causes. For example, a decline in gross profit is actually a symptom of many root causes, such as ineffective pricing, too much rework, poor purchasing pricing, or wastage. So knowing your numbers will enable you to spot any early warning signs of potential issues. For example, monitoring how long it takes your customers to pay you allows you to quickly respond if that number starts to increase. So areas of strength and weaknesses will be highlighted for your business. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means that you have reliable financial information to base your decisions on, and knowledge is power. So the more you know about your business, the better your business can be. So we'll be reviewing each of these key reports to help you understand what you can learn from them. We'll work through an example to show key learnings and things to look out for in your reports. We'll use the same fictitious company, foods company, for all of these examples. So now I'm just going to run a quick poll just to see what you find the most challenging financial statement to interpret. So poll should be popping up now. So yeah, let us know, which financial statement do you find most challenging to interpret? Okay, starting to get some responses coming in now. Yep, awesome. Few people saying the trading account, most people saying the statement of changes in equity. So we actually run through that today, so that's really good. I'll just leave that open for a little bit longer and I will continue on. Okay. So first we'll start with the trading account. So your trading account, not all businesses may see one of these in your financial statements, but your trading account tracks your sales, variable costs, and gross profit to calculate the return you're achieving before you deduct your fixed overhead costs. So your gross profit percentage indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you had a few different office locations or a few different kind of sub branches within one branch, you could have a different trading account for each to understand how each of those is performing. So the key thing about a trading account is that it lets you see that small adjustments to the items in your trading account can have a huge impact on your overall results, which I will demonstrate now. So this is an example of a food manufacturing company's trading account. So as you can see, they had sales of just over 1 million. They had cost of sales of 318,000, giving them a gross surplus from trading of just under 700,000. So their direct costs were just over 450,000, and that gave them a gross surplus of 248,000, giving them a gross profit percentage of 24%, sorry. So let's say this company undertakes some coaching with their accountant and implements a strategy to increase their customer retention rate, resulting in a 10% increase in sales. Let's say they also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. They may also renegotiate their contract with a delivery driver, resulting in a 5% saving in their direct costs. So as a result of these changes, you can see that their gross profit has increased from 24% to 35%. So understanding your trading account allows you to identify areas where small improvements can have a really big impact on the profitability of your business. So I will just close off that poll from before, and I'm going to run another poll. So this one is seeing if you can understand how you would calculate gross surplus. So I'll open that poll now. So hopefully with that slide still up, you should be able to get this, but just have a go at it. Cool, starting to get some responses coming through now. Awesome. And I think pretty much everybody is getting that right, so that's really good. So yeah, the correct answer there, if you haven't answered yet, was revenue minus cost of sales minus direct costs, and that's what's going to give you your gross surplus. Cool, so I will continue on from there. Okay, the next one we're going to talk about is your profit and loss statement. So it's also known as an income statement. So this shows all of your earnings and costs over the year and tracks the overall performance of your business. So it matches your income and expenses for the period with adjustments made for timing differences. For example, sales that have been made, but the money hasn't yet been received for them. It's important to remember that profit is not the same as cash. So the profit shown in your profit and loss statement includes non-cash expenses such as depreciation. So you must ensure that you have sufficient profit to cover cash costs such as loan principal repayments, asset purchases, and drawings. So your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years. So to compare your business performance to a prior year or sometimes even to other similar businesses. So also businesses are generally valued using a multiplier of earnings. So your profit and loss statement is a fundamental driver of the value of your business. So the higher your earnings and the higher your profit, likely the higher your business value. So it's important to understand this one. So this is an example of a profit and loss statement using the same fictitious food company that we were looking at before. So we've taken that gross surplus from their trading account and then listed all of their expenses followed by the owner's remuneration to calculate the net surplus. So conversely to the gross surplus we saw in trading, now we're talking net surplus. So as you can see, the company is actually currently trading at an overall loss of 113,000. So let's say the company undertakes a review of all their expenses with their accountant and identifies some potential savings to be made to their insurances and rent. So they may contact an insurance broker and maybe even their landlord as well and negotiate a 5% reduction in both of those expenses. They've saved $597 in insurance and just under $3,000 in rent. However, you will notice that accountancy fees have gone up. So remember in the previous example, the company had engaged their accountant for coaching and other services. So despite the increase in those accountancy fees, the overall net surplus for this company has increased by $138,000 to a $24,000 profit from an $113,000 loss. So, and that's due to the savings that were made and those minor tweaks that were made to the trading account. So, time for one more poll for the moment. Just close that last one off. And so now I'm going to reopen this poll. And what you need to do here is try and select which of these items would come under expenses rather than under your direct costs in your trading account. So have a go at that. Some of the answers are on the slide, I think, maybe. So have a go. And there's actually 2 of the answers are correct. So if that gives you a hint. Awesome. Seeing these results come through now, lots of people are choosing the correct ones. So just give it a little bit more time. Okay, so the correct answers are marketing wages and bank fees. So they would be expenses that would come under under your overhead expenses rather than your direct costs in your trading account. So factory team wages would come into your trading account because those could be directly attributed to the product that you're producing. And also same for pallets for shipping stock. They're also a direct cost. Cool. I will now move on. And now we're at the balance sheet. So this is also known as a statement of financial position. It provides a snapshot of your business's financial position at a specific point in time. So it measures the net worth of your business, which is your assets minus your liabilities. It also shows if your business is solvent. So if your liabilities are greater than your assets, then the business is actually insolvent and urgent action is needed to fix this. So you can compare different periods to determine whether the business's net worth is increasing or decreasing between years, and you can track the strength of that business. So the stronger your balance sheet, the easier it will be for your business to survive a downturn. So very crucial at the moment. It also provides a basis to calculate some key ratios such as debtor days and inventory days. And we'll talk a little bit more about those in particular soon. So as you can see in this example, this company is actually currently insolvent as it has more liabilities than assets. Oops, sorry. No, I'm on the right slide. So its working capital is also negative as it has current assets of 138,000, and that is less than its current liabilities of 162. So this means that the company cannot pay its short-term debts from the limited cash, debtors and stock on hand that it has. So urgent action is required to remedy this. The business needs an injection of funds of at least 305,000, which may be in the form of share capital or a shareholder loan. So assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. So over the long term, the company could implement strategies to reduce their debtor days and their inventory days to increase their cash flow. So to calculate your debtor days, you divide your debtors by your sales and then multiply by 365. So this tells you how long it takes your customers to pay. So currently this company's debtor days are 26. And this means that on average, it takes their customers 26 days to pay their bills. So if they updated their terms of trade and maybe requested payment within 7 days, and they might manage to reduce their debtor days by 5 to 21 days, this means that they'd have an additional $13,000 available in cash flow improvement from that change. So next up is inventory days. So to calculate inventory days, you divide your inventories by your cost of sales that we saw in the trading account, and then you multiply it by 365. So this tells you how long the business holds its inventory before selling it. In other words, it shows how long your cash is tied up in that inventory. So this company currently holds its inventory for 74 days. So If they were to review and update their inventory processes and reduce the amount of inventory they had on hand, they might be able to improve their inventory days by, say, 9 days, and this would result in a cash flow boost of $7,800. So while this total cash flow gain of nearly 22,000 won't fix the solvency issue, it does demonstrate how much cash could be saved with some help from their accountant. And this can be something that could be run as a project. And yeah. So next one, so this is the statement of changes in equity. So this is the common one that a few people found the most hardest to interpret. So we'll go through this now. So the statement of changes in equity shows what happens to the profits. They could be paid out as dividends or kept in the business as retained earnings. So it represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent. Remember, if the company has more liabilities than assets, it's insolvent, and funds will need to be paid into the company. So let's look at an example. So this company here, so it's Foods Co again, and it has accumulated losses for at least the last 3 years. So this means the company has no retained earnings and is currently insolvent. There is no money to pay out as dividends and no money to reinvest in the company to purchase new assets. So in this case, the directors must take action now to increase the profitability of the company. Next up is the shareholder current account. So this records all funds introduced to the business by shareholders or taken out of the business as drawings. So it can help you monitor your personal expenditure from the business. And for businesses with more than one shareholder, it maintains a balance of the amount each shareholder has introduced or withdrawn from the business. It shows how much the business owes to each shareholder. If the account is overdrawn, it actually means that the shareholder has taken out more money than they've put in and now owes the company money. So to put the account back into a positive balance, the shareholder can repay that loan, or the company could increase its profits to pay a shareholder salary, or a dividend can be declared. So if your shareholder current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business. So this is the shareholder current account example for Foods Company. It shows that at the start of the period, the company owed its sole shareholder, Mr. Doe, over $29,000. So he has introduced $2,000 into the company during the year, but has taken out over $9,000 out of the company in drawings and life insurance payments. So this means that at the end of the period, the company now owes Mr. Doe just under $22,000. So the amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make that repayment. Because this example company is insolvent, Mr. Doe will actually need to introduce more funds into the company so that it's not trading while insolvent. So to ensure that the company will be able to repay the funds introduced, a profit improvement strategy should be implemented for this company to make it become profitable. For example, we demonstrated earlier in the trading account and in the profit and loss statement examples of how those small changes to processes could result in an improvement of $138,000 per year. So it's not sustainable for the shareholders to keep introducing money into the business if it's not profitable. And the last report we're going to look at is the fixed asset register. So it's also known as a depreciation schedule. It records a business's fixed assets such as vehicles and plant and equipment, and it facilitates the spread of the cost of those assets over their useful life. It provides a basis for keeping track of the business's assets and can be useful to determine when assets actually need to be replaced, and so that that replacement can be budgeted for. It's also actually useful when selling a business, as it records the current value of all the fixed assets. So this is the fixed asset register of Foods Company. So you can see the first column of the fixed asset register lists all the names of the fixed assets, with the second column listing the cost of the asset on its purchase date. The next column, this shows the opening value of that asset at the start of this financial year. So this is the cost less the closing accumulated depreciation from the previous period. So the next two columns show any purchases of new assets or disposals of old assets. So a disposal could simply mean that the asset has reached the end of its useful life, and maybe it's scrapped. It's not always that the assets are sold. Then we have the depreciation rate and method of depreciation used. So this company uses the diminishing value method, which depreciates each asset by a constant percentage each year. So the next column shows the depreciation for the period that these accounts relate to, followed by the closing accumulated depreciation. So this is the amount the asset has been depreciated by since it was purchased. And that gives us the closing value. So that's the current closing value of the asset. So this is actually the value that will be recorded in your balance sheet too. So that sums up 6 of the key reports that you should be producing and reviewing regularly. Each report tells a different story about your business and aids in your decision making in a different way. If you have any questions about any of these reports, send them through now and we will be able to answer them at the Q&A at the end. So in the meantime, I will pass you on to Rick, who's going to cover the difference between profit and cash, the key drivers of business value, protecting your assets, adopting best practice, and the next steps that you can take. Rick.
Sorry, guys, it took me a while to unmute myself there because the button was hidden. So I do apologize for that. You can hopefully hear me now. Right, thank you so much for running through those reports, Julie. And I know that, you know, for myself being a non-accountant, there's a lot of stuff in there that does seem quite complex. So I'm sure the majority of you will be operating on Xero and you'll, you know, you'll be recording really good data. So it'd be great to familiarize yourself with those reports. And then from Julie's great practical advice, you know, run them and check them over. So once you become more comfortable with that and the reporting, there's of course so much more to running a business that will benefit you and enrich that. So what I wanted to cover off initially is helping you understand the differences between profit and cash. So a phrase I have lived by for years, I learned it off a great accountant probably about a decade ago, was the phrase that, you know, turnover is for vanity, profit is for sanity, and cash flow is reality. So it's actually really common for business owners to get frustrated that their bank account doesn't seem to match their profits. So it's essential that you understand that the difference between profit and cash is why high profit doesn't necessarily result in more cash in your bank account. Profitable businesses can actually go out of business just because they're starved of cash. And also, a business running at a loss can survive for years because it has access to funds either by investors or financiers. So, in other words, really, cash flow is business's reality. It is the oxygen that it actually runs on. So, what I wanted to show you now was a bit of a demonstration on how some things are profit, some things are cash, and some are in fact both. So to demonstrate the difference between these, you consider things like GST. You know, it shows up in your bank account, okay, but it is actually only affecting your cash balance and not your profit. It's not your money that you hold. Another one is loan repayments. Again, these affect your cash balance, but they don't affect your profit. Interest on your loans that you pay, they affect both your profit and your cash balance. You'll see them in both areas. Asset purchases only affect your cash balance, and asset sales also only affect your cash balance. And then depreciation, that only affects your profit. It's not, you're not seeing real money leave your business when you depreciate something. So a way to consider this is you think about, you know, is there actually a transaction? And then the other thing is, are you actually invoicing for it? So these are some key examples, and they can really trip people up. So sometimes your bank balance looks good, but the business doesn't, and equally it can be the same in reverse. So as you can see, even if your business has achieved a healthy profit, there may not be any cash, and that's where, again, things like tax bills, loan repayments, and buying new assets can trip us up because it's not reflected in the actual profit and loss. Now, what we'll do is Julie's got another quick poll to launch. So what we want to know here is, do you know whether loan principal payments affect your profit or your cash? Cool. And so I can see we've had a few responses for this so far. So I'll leave this up there for a minute. Great. I think the answer is hiding right behind the poll on my screen, but yeah, excellent. Fortunately, as well, I've seen from these polls so far that the old adage that you can trust the audience knows the average has been correct so far in these polls. So you're a well-educated bunch so far. Now, I'll move on to the next slide, and this is about the business cycle. Okay, so this is there's some key things here that it's important to understand, and these things do happen in a cycle, and it's hard for you to actually break this cycle or operate outside of it. So, firstly, business owners need to invest money in the business. That's typically how we get started. This money can then be used to purchase the assets needed to run the business. The business may also need additional funding for you to buy all the assets that you need. So in this case, they may take out a loan to finance the purchases, or could be any other way. Then these assets are used to generate a profit, to generate an income of some sort. So you can increase your profit by growing your sales or margins. That's sometimes where buying more kit, buying more assets helps, because it might make you more efficient, help you charge more. But overhead expenses can drain your profit, and as a result, it can cause a loss if it's not managed. So you've got drains. The next area is that profit then gets turned into cash. So the drains on your business here include a slow collection of debtors, as Julie was covering earlier. High inventory days, again, is just cash sat on the shelf. And then loan repayments and tax payments and payments to suppliers are all draining the cash out of your business. Now, a business can achieve cash gains by collecting their debtors faster, decreasing their inventory days. If possible, can you have stock just in time, and negotiating longer payment terms with suppliers. And then, of course, everybody's favorite, while you use an accountant, reducing tax. Now, these are all key areas where we want to be able to help our clients, hold on to more cash essentially, because with that being the reality of the health of your business, it helps for better sleep at night if you know that you're more liquid. Now, to complete the circle here, so the owners can then take cash out of the business as drawings or as personal loan repayments, and the remaining cash can then be reinvested into the business to purchase more assets and again generate more income. So the aim is to go through this cycle as quickly as possible so you can increase your return on investment as a business owner and as a shareholder. So let's say that we've got cash kind of dealt with a bit better in our business. Another thing to understand is the key drivers of business value, and this will be different for different types of businesses. So part of knowing the numbers is understanding and measuring the drivers of your business value. For a lot of people, their business forms a big part of their retirement plan. And so you want to get to the end of your business life with an asset that will be what you expect it to be worth. Now, these drivers in your business could be monthly recurring revenue. It could be revenue growth, could be revenue per client, could just be sales or profit. So they will be different in the business. But again, this is where we like to work with our clients to help them understand it. It might be the help that we do is simply to introduce you to a broker or somebody else. So don't be afraid to reach out, because this is often a very crucial number for you to understand in your business. Now, as we dive onto the next slide, so enhancing business value. The tactics for doing this: implement a clear plan. So your business must first develop and implement a clear plan and a document so for your organizational structure and the key roles within your business. This saves so many headaches. If you have a clear map of who does what in your business, not all the problems come to the boss, and you end up with a business that's far more efficient. Another thing that we always recommend is establish a cloud-based and real-time reporting system so that you can make better and quicker decisions. And you'll have typically then a better documentation of your business systems and processes. Again, reducing the reliance on the business owner. Then another thing that we recommend is identify and manage risks. So not many businesses have these, but a risk register. This is where you're able to, you might write down all of the things that could negatively impact your business. We certainly had it. COVID is, I'm sure, a fresh memory in a lot of people's minds here from running a business, where all of a sudden supply chains globally just stopped. Huge impact on nearly all businesses. Now, something similar to that might happen sometime. In New Zealand, we're not the most robust country with our infrastructure. If there's a massive issue at a port, we tend to know about it in this country. If there's floods that wipe out some bridges, we tend to know about it. So, document some of these risks that you think could impact your business, and then establish how bad could they be for your business, and what's the likelihood of them happening. And then from that, you can prioritize which ones you want to deal with. Moving on to the next slide, protecting your assets. So this is another area where we really want to see our clients have the best outcomes. So in terms of these, there are 8 common ways here that you can improve your business, and improve your asset protection, and I'll just go through them in order. So firstly, check has your business been set up as a company rather than a sole trader, so you can limit your personal liability. Okay. Secondly, consider who should be a director of your company and which assets are going to be held personally by directors. Commonly, we would suggest to mum and dad businesses, especially with young kids, you might not both want to be directors, because ultimately, if there was an employment issue or accident or any uninsurable events were to happen, then it could be really detrimental to the family. So yeah, it's not, there's more risk than status in the title of director. So do really consider that in households. The third I like to talk about is ensure that you have security over any money that you've actually lent out to others. They could be some of your clients, it could be your own business, it could be anything that you've done there. So make sure that you have security over your equity. Number 4 is consider alternative ownership structures for high value assets. So for example, if you're a business operate a business, and the business owns the commercial premises that you use, you probably want to consider moving the ownership of that premises into a separate entity, because from a risk perspective, and that could be risk from creditors, that could be risk of access, or whatever it might be, you want to make sure that you're covered there. Number 5 is that we want you to review your terms of trade and credit policies. Essentially, you are lending money when you extend credit to your clients. And so make sure that you have adequate protection of that, and that you are ultimately only really extending credit to people that you trust will actually pay you back. Number 6 is that we want you to review your insurances, and do this regularly. We all know the pain of insurance premiums rising rapidly over the last 4 or 5 years. So make sure you are reviewing them for both your own sake in terms of money, but also, have you got the adequate cover? Are you insuring assets that you own? We've seen people paying insurance premiums for things that they've disposed of. Is your business still doing the same thing that it was doing? You actually got that insurance in the first place. So make sure you're covered. There is no point in paying for an insurance policy that won't pay you. So do check that that's accurate and up to date. Number 7 is that we want you to undertake financial planning. So manage your own personal wealth outside of your business. Our happiest and most successful clients do this. And although this is work that we don't do much of at all, we have people in our network that we really like to recommend that you can have a conversation with, because if the business is there supporting you, then hopefully you can have some kind of asset base or wealth that will then look after you as well. And finally, this one's a little grim, but estate planning. Okay, so for the hopefully a long time in the future, do ensure that you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation, or causes, or what have you. So it's not an exhaustive list, and there are some, these are just some of the ways that you can actually protect both your business assets and your personal assets. And we do like to make sure that we can help you identify those risks and get the adequate protection where you need to there. So the next thing we want to see our clients do in their business is adopting best practice. Our happiest and most successful clients have an annual business plan, right? And it isn't a 30-page book that sits in a filing cabinet that is just there to gather dust, okay? It's usually a 2-pager pinned up on the wall that the whole team knows about, and you're all then operating to that common cause. The next thing is an annual forecast. Now, again, there are good forecasts and bad forecasts, but make sure that you have a forecast in place that you can adjust so that we know that you are hitting your targets regularly. Because if you just review things annually, if you missed it a little bit at the beginning, you could be way off at the end. So make sure that you've got the annual forecast in place with regular checking. And then another thing is ongoing reporting and accountability. So just recently, I was with our business coach, the Sidekick Group's business coach, and I really should have refreshed my mind on this slide, but there was one thing that stuck out to me massively. People that make a promise of accountability to an independent partner or accountability coach have a 95% chance of hitting their targets. So if you have a great annual business plan with lots of things, lots of key pillars in your business to do that will make an improvement and generate more revenue and wealth for you, you report against it regularly, and you have someone holding you to account, there's a 95% chance that you'll get there and you'll do the things that you need to do. So that is how you really do drive success in your business. The secondly, knowing your numbers is just the beginning. It's a great starting point. Okay, so do know your numbers, do understand what's going on in your business, but then there are so many ways that you can make improvements on that. On to the next slide. So as we're getting close to wrapping up, so hopefully just wanted to cover off, hopefully you guys have had some questions that you've been thinking of, and no dumb questions in this webinar, by the way, okay? You've got fellow non-accountants here hosting, so ask any question you feel, and we will deal with it. But what I would love to see all of you do out of this webinar is that you get started on something and it doesn't have to be massive. Okay, so write down 3 actions or projects that will add value to your business. And they might be in marketing, they might be in a cost review for your business. It could be in reviewing your suppliers or whatever it might be. So come up with 3 things, 3 projects you could do, and that would make a noticeable improvement to your business. Now, with very, very rose-tinted goggles on it, try and believe that a problem is an opportunity to create a project, okay? So, when you're faced with something like this, try and take it on with some optimism and search for ways to make improvement. So, okay, often that's where the fun of running a business actually lies. Dopamine comes from is when you're actually creatively looking to address your problems and deal with them. And then a tad of advice here is that hopefully, doing nothing shouldn't be an option. So business can be really fun. Get yourself some projects, reignite, and actually pick some big goals to go and attack. So that would be something I would love for all of our clients to do. Oh, and with your projects, if anyone's brave enough, please do chuck them in the chat, because I would actually love to see what kind of projects people are wanting to take on from this. And again, if you've any questions, just chuck them in the Q&A or the chat now, because we've got Vic and Julie looking at those. So now you look at this and you might think to yourself, right, I've got all these projects to do. There are things I can be doing in my business, and there might still be some kind of knowledge gaps for myself that you want to address. So we are here to help, and we would love to help you with that. Okay, and that might just be a case that we're putting you out to our network or helping you make decisions. But Julie, if I can just have the next slide. So ways in which we can help our clients tend to be that, firstly, we love to help our clients with business planning. whether that be an annual business plan review. If you already have a business plan, great. Share it with your accountants, with your advisors, with your wealth advisors, because the more people you have looking over this, the better the outcome will be most often. Next, the cash flow forecast. We can help you with tools so that you can run your own, or we can do one with you / for you, okay? But an annual forecast for your business, cash flow forecast, is critical because it helps you understand what you can and can't spend. It also often gives people a great peace of mind that, I see people all the time when they get really stressed that their business costs them 20 grand a month to run, right? Because without a plan, that's a lot of money to find. So if you can build this into a plan, you accept it, then very often it takes a lot of the stress away from that. Thirdly, accountability coaching. Like I say, be in that 95%, or give yourself that 95% success chance by having someone independent, hold you to account, make sure you are doing what will actually improve your business. Fourthly, the Sidekick session. So we just want to catch up with our clients. That is, if you're on this webinar now, rest assured, you can reach out to one of your team in the local offices or wherever where you work with your Sidekick professionals, and we will offer you a free Sidekick session where we want to help you uncover the things that we've spoken about in this webinar today so that you can get some actionable plans. We would love to do that. So honestly, feel free to reach out. And then lastly, in a couple of our offices, we do offer group training sessions as well. So that's where you can have some kind of peer support, work with people in your perhaps in your industry category, or people that might have similar crossovers, and then you're actually able to work in a team and get the answers that you want and the support that you need to run a successful business. Now, Julie will launch a quick poll because, sorry, just as a quick and efficient way for us to be able to help you with this, if there's anything on that list that you've even got a slight interest in, or you'd like to know costs, or you'd like to know what the process is, you can just tick on here, and a member of your local team will reach out to you, and they'll be able to actually help you in terms of how to get started on this or just move it along. There's no catch to the Sidekick session, so I've got to fill in the form, so I'll do that now. Right. So dive into that, and you can see if there's anything in there that you'd a member of the team can just reach out to you and help you with that. So look, that's the wrap up from our part. So hopefully this has really helped you understand the numbers in your business and also some projects that you might be able to work on. What I'll now do is we'll move on to the questions, and it'll have Julie and Vic rejoin us to cover these off.
Yeah, so I've had a couple of questions come through. The first one was from Lynn. Lynn wanted to know, when would you use 40% diminishing value for smartphone depreciation as opposed to IRD rate of 67% per year?
I can cover that as a non-accountant, but Julie, would you like to?
Yeah, so I guess in most cases, assets you can choose the IRD rate to use. The reason, which is the 67%, right? The reason why you may choose 40 is maybe you've got a previous example where iPhones are actually lasting 5 or 6 years in your company. I know I've worked for a company in the past where iPhones get dragged out for about 7 or 8 years. Probably not that efficient once you get to those later years, but if you want your asset register to reflect the useful life of your assets, I think you can choose another rate that is lower. So you obviously can't choose higher, like you couldn't choose 100%. IRD rates are kind of your upper limits. Hopefully that helps.
Um,
So it's
What that tends to do as well is if they are holding their value, if you were to dispose of your phones later on and you manage to sell it on Trade Me for $500, you don't then want to be hit with a tax bill for a lot of that. So it does protect you on both sides there. It's to help you not over claim for an asset.
Cool. And just one more question as well that I saw come through from Felicity. She was wanting to know, what is a good example of cloud-based reporting?
Cool.
Rick,
There
I'll
are
leave that one for you. Rick's
yeah,
passionate
look,
about this, so
oh, I am passionate about this, right? Because when it comes to cloud reporting, the first thing I want my clients to think about is what is it that you want to report on? If it's purely financial, it's literally just the bird's eye view of your business. I reckon that Xero is going to do a really good job of that. And it's got some really good reports and it's got a improving user interface. And they're also buying up other companies that do the visualization better. So things like the Analytics Plus, the SIFT, I think that's just been acquired by them. So if it's purely financial, start with Xero. And if you need more, I'd run out of fingers to count them all on. Spotlight, Futurely, Fathom, all of these. They're really good. So pick one that works. Another thing that you might want to consider with it being financial reporting is how much do you want to include your forecasts into that? Because reporting on history is easy, but if you want to actually create some forecasts and scenarios and plans for growth, then I would recommend something like Fathom or Spotlight to take a look at those ones. Um, if your cloud reporting is actually more to be more, say, operational, again, more future focused, then it might be something like a really good sales reporting tool that you want to take a look at. So something like HubSpot or Salesforce or Zoho are great CRMs for being able to track future opportunities in your business. And then if you're in a business that's say more product orientated or e-commerce, then again I would look for say some of the systems there that have really good built-in reporting, Shopify and Dia and all of those. So there's a lot out there. The first thing to determine is what do you want it to do, and then you'll be able to find the right one from there. Oh, another word of advice is if you're ever looking for reporting that's linking into Xero, make sure that you go to the Xero apps page first. Okay, so there you will have all of the approved, vetted, and legitimate businesses that do reporting, because the last thing you want to do is get some malware on your computer, upload your credit card, and then link it to your financial reporting system. So do make sure you're using a trusted, vetted system, and Xero is a great place to start.
Awesome. Thanks, Rick. And now just David is wanting to know, wondering about the process of turning drawings into a dividend. Are there any issues with that, like tax?
I'm going to sit this one out.
So I think there might be a few different concepts here that are getting overlapped. So obviously, drawings is something that's not in your profit and loss, and it's in your shareholder's current account. Sometimes when your shareholder current account does get overdrawn, I'm just trying to think about the best way to explain this. Sometimes the company, if it's profitable, may pay a dividend, and then that goes into the shareholder's current account. So it effectively offsets those drawings so that the shareholder isn't in debt to the company. But yes, when you declare a dividend, there will be tax implications of that. and that's something you definitely want to be discussing with your accountant. But yeah, we can talk specific scenarios on any of that if you would like a bit more information. But it's not, I guess the key is it's not really turning drawings into a dividend. You're using a dividend to pay out a profit to the shareholders. Hopefully that helps.
Cool. That looks like all the questions we've got for now. Maybe we could just give it another minute or two, see if any more come through.
Great. And was there anyone that's bold enough to jump into the chat and tell us any kind of projects that they were going to get into? Julie and Vic, you'll have to tell me if anything comes through because I am terrible at operating Teams, so I won't see it if anything does come
Not
through.
at this
nothing
point.
yet.
I think
Okay,
people are
cool,
probably
cool.
thinking about it, or hopefully thinking about it.
Yeah, awesome.
So
All right, lovely.
no other questions that have come through, Vic?
No other questions, no.
Awesome.
Cool. All right, great.
There you go. Actually, David's jumped in now, and one of his projects is looking at bringing in shareholders. So yeah, one of the key benefits of operating in a company structure is that you can access equity, you can bring in other shareholders. Yeah, Rick, got any thoughts on that one? That's an exciting project.
Yeah, definitely. I can't see the question, but yeah, certainly thinking about for your own business how you intend to do this, because I see it. We've got probably 2 or 3 on at the minute of businesses where they're doing it in different ways. So bringing on a shareholder because the company needs more working capital. And then, so what's happening is they're diluting the shares in the business. So it might have 100 shares, and then they'll say, well, if this person comes along with whatever money it is, then we'll make it so that they've got 200 shares in the business, and the business has that money to spend to grow. And then the 2 shareholders each own 50% each. So that's one way that I've seen clients do it at the minute. Another way is where the business owner, for whatever reason, sell down part of their business to people coming in, and they're doing it as a reward to themselves. So the company would still have 100 shares. They might sell 20 of them. They receive the money as the current owner personally, and the new business owners in there carrying on with the business as they intended to. So definitely something that you need to consider when you're selling shares or bringing in business partners. Is it the company that benefits, or is it the owner? Because there is a mechanism for each way.
Nice.
Great. Cool. Now, Julie, did we have the word cloud? I think I
yes.
skipped over it earlier in one of my slides. I do apologize. So what we'll do now is we'll quickly launch a word cloud. So dive in and answer this poll, and then I think we can wrap up there.
And also there will be recording the webinar slides and also a workbook that goes along with it sent out to everybody as well.
Excellent. All right. Well, it looks like some people have got some work to do. We'll keep that slide open. I'll sign out from here. thank you very much, everyone. Really appreciate you giving up some your valuable time in this afternoon, and so provided value to you, and that you achieve those goals. Thanks very much, guys.
Awesome.